Hi, my name's Alex. I'm a CPA with Stronghold Accounting, and not knowing the difference between cash versus accrual accounting as a business owner could be costing you tens of thousands of dollars at year end. Today, I want to go over the difference between accrual basis accounting versus cash basis accounting and why it's so important for you to know as a small business owner. So to keep it super simple, cash basis accounting is exactly what it sounds like. It only records the transaction when cash is moved in or out. So let's say, for example, you're a lawn service company. If you performed lawn service on January 2026, but you didn't receive cash until February 2026, you would not record that revenue until February, even though you performed the service in January. And the same goes for your payments out. Even though you paid insurance up front for the year, right? Let's say $1,000 up front for the full year, you record that full amount in January when you paid it. You do not spread that cost over the year. It only matters when you paid that amount or you received that cash, right? Versus accrual basis is that this records revenue when earned and expenses when incurred. So that same example with the lawn service you did in January, you would record that revenue for January even though you didn't receive the cash until February. That's what that accounts receivable balance is for. It's just a matter of timing difference. And the same for if you paid insurance expense upfront for the year, you wouldn't show that full expense in January. You would expense it over time. It gives you more insight into the ebbs and flows of the business, and you can see your expenses spread out over time more evenly. And so it gives you a better ability to analyze your financials. So you may be asking, okay, why don't we just all go with accrual basis? Well, the problem is the way you analyze your financials may be different from the way you file taxes. So we may look at the financials together with my clients on accrual basis, but when it comes to filing taxes, they file on a cash basis. Now, filing your taxes on a cash basis can be super advantageous. For example, let's say you had $1 million in sales throughout the year, but you only collected $750,000. If you filed taxes on accrual basis, you'd be paying tax on obviously the profit. You'd be paying tax based on the profit after that $1 million in revenue. Versus on a cash basis, you would only have to pay taxes based on the profit that flows from $750,000 in revenue, because it's only based upon what you received, not what you earned. And the same goes for when you're making payments. So if you're making a prepayment, let's say of $50,000, right, for a service that may be incurred for the next year, because you're making that cash payment December of 2025, let's say, you can deduct that as part of your 2025 expenses. Knowing the difference between cash basis and accrual basis is so powerful. And in that example of the $250,000 in revenue difference, that million versus the 750, that would translate to, if that just flowed directly to profit, that $250,000 difference, assuming a 30% tax rate, that's $75,000 that you don't have to pay the IRS because you understood that difference. So this is critical to know, not just from a tax filing perspective, but also a business analysis perspective. When you analyze the business, in my opinion, it's better to look on an accrual basis, but when you file taxes, it can be advantageous to file on a cash basis. My name's Alex. We help small businesses with their bookkeeping and provide financial guidance throughout the year. You can check us out at strongholdaccountants.com/free consult. And hopefully this was helpful and saved you a lot of money when it comes to year-end tax filing. Thanks for watching. Take care.